Today we want to talk about international investing with the title International Portfolio Management. Next slide. In the second slide we have this game plan of having 7 sections. We want to first talk about the correlation structure among national market. And when we talk about international diversification, then the correlation coefficient structure is very important, and that's why you have learned in your Bsad 180, 181, and 282 when you learn about portfolio theory. So we want to talk about correlation structure among national market, and then we want to talk about what would be an optimal international portfolio may look like. And then we wanted to do a return decomposition, look into the relationship between the return measure in US dollar, the return measure in local currency, and the exchange rate. And that will be followed by a stylized fact. We call that home bias. Home bias means that investors tend to invest in those security and those capital market not far away from their home country. And then we want to move on to talk about international money market. Money market are those debt instruments, those fixed income instruments with a maturity less than a year. And then we want to talk about international bond market. Bond market are fixed income market where the maturity is longer than a year. And then we want to talk about international equity market. That will be the stock investing. So we have this 7 sections. Next slide. And this chart show that the involvement of the U.S. investor having their wealth investing in those asset market outside of the United States. As you can see that starting in around 1980, barely any American household invests their wealth outside of the United States, and we're talking about less than 1%. So 99% of the wealth that have been invested domestically. But as time go by, this percentage has been approaching 20% in recent years. So right now we have about 80% of the wealth investing in the United States, about 20% invest outside the United States. And this kind of international investing of course open up the investment opportunity set for American investor. Next slide. And we learn from portfolio theory that the lower the correlation coefficient are, and we will be able to diversify away more of the portfolio risk and uncertainty. So the ability to diversify away the risk by holding a well-diversified portfolio depends on the correlation structure. And this kind of diversification concept is consistent with the notion of not putting all the eggs into one basket. But here correlation structure is about the co-movement or the interrelationship among those baskets. And simply by putting all of eggs, putting your eggs across different baskets does not necessarily imply, does not necessarily lead to a lower portfolio risk, in the sense that if one basket drop, all the other basket would also drop, okay, then we don't have any egg left, okay. And this is the kind of situation we talk about a very high correlation. When one drop, the other one also drop, that is a perfect positive correlation coefficient, and that will lead to like 100%. And on the other hand, when one drop, the other one goes up. This is a kind of negative relationship. Then we have a correlation coefficient of a negative value. And of course, the lowest possible correlation coefficient will be -1. That's why you have learned in your statistics class. Next slide. Okay. And also the ability to diversify away portfolio risk through diversification, it really depends on your investment opportunity set as well. Okay, for example, in this particular chart, if we allow ourselves only invest in a small domestic nation like Switzerland, and as you can see that is representing by that green curve, the lowest possible standard deviation would be 0.44. So we still have 44% of annual standard deviation. That is relatively high. On the other hand, if your investment opportunity set is in a relatively large, well-established capital market like in the United States, that is represented by that blue curve. And the standard deviation investing in United States through holding a well-diversified American portfolio, we're talking about we can reduce the standard deviation to 0.27, that would be 27%, which is much lower than the 44% of the Swiss investor will be able to achieve in their own country. In other words, the American capital market is better endowed with much more opportunity to diversify away the risk. And by the same token, if we further expand our investment opportunity set, not just within the United States, but also outside of the United States, including the United States, that would be international stock, that would be represented by that red line. Okay, if you look at that red curve, with a well-diversified international portfolio, we will be able to reduce the standard deviation all the way to 12%, 0.12. So we're talking about these three situations. Then you can see that there is a lot of things. There's a lot to be gained by being able to invest in outside of the United States, and we'll be able to gain by having a well-diversified international portfolio. Next slide. And in this slide, okay, we have the return correlation coefficient between 1980 to 2012 if we use this period of sample. And let's focus on the bottom row. That would be the number for United States. So that would be the correlation coefficient between United States and a variety of those major foreign market out there. And let's look at this set of numbers. Okay, they are, of course, within +1 and -1. You cannot have a correlation coefficient higher than +1. And the majority of them have a value higher than 0.5. So if you're talking about a range of a -1 to +1, and we have pretty much all of them at a higher range, above 0.5. And there are only two nations here has a correlation coefficient lower than 0.5. One is HK, that would be Hong Kong. The correlation coefficient between Hong Kong and the United States is 0.48. And another nation is JP, that's Japan. The correlation coefficient between Japan and the United States is 0.38. And these two nations has the lowest correlation coefficient among those almost 10 global foreign market. And this is not surprising, in the sense that these two nations are they are Asian capital market, and they are very far away from the United States. Their economy, okay, work in quite different way relative to our economy. Okay, our economy is more of the domestic consumption driven kind of economy, while Japan and Hong Kong are more of exporting kind of driven kind of economy. Because the fundamental of economy are quite different, therefore the rate of return in those Asian markets relative to our stock market are quite different. They are just different. And the difference in terms of diversity, return diversity, is good. It's a very good thing for us to diversify away those portfolio return. We will need to have investment that has a unique return attribute related to our default investing, that will be investment in the United States, in order to diversify away the portfolio risk. Next slide. And we have a performance measure, we call that Sharpe ratio. Sharpe ratio, SHP, will be the average return of one portfolio above the risk-free rate. So mean RI minus RF. That is a national market risk premium. So we're talking about dividing a national market risk premium by the standard deviation of that particular national market, and we come out with this particular performance measure, holding another factor constant. We want to see this ratio to be as high as possible, because denominator is a risk measure. That will be the standard deviation, while the numerator is the benefit, is a return measure. So here we're talking about given 1 unit of the risk, how much of the return and benefit we will be able to obtain. So holding 1 unit of the risk constant, of course, the additional return, the market risk premium, we would hope that could be as high as possible. Then that gives us a better risk-return trade-off. Next slide. And let's look at the average correlation coefficient among major international markets from 1980 to 2012. As you may notice from this chart, is that as time goes by, that average becomes higher and higher. Before 1995, before 1995 or around 1997, those average correlation coefficients are roughly between 0.2 and 0.6. And after 1997, 1998, and all the way into this century, and those correlation coefficients nowadays are between 0.5 and kind of approaching 0.8. So correlation coefficient has grown quite substantial. And this means that the ability to obtain diversification benefit through international investing has become lower and lower. Okay, in other words, it's harder and harder to have this kind of international diversification benefit. And there is a main reason why it's harder to have this kind of benefit by investing stock overseas. And the reason because the globalization. And we have this kind of we have intense globalization in the past 20-25 years. And particularly with WTO, came into play in around year 2000, and the amount of international trade has been going up, and a lot of international firms are doing financing globally, and so nowadays the economy, the global economy is much more intertwined, and we have the relationship among those international companies become tighter and tighter, and of course that provide a high efficiency in terms of the leading to lower cost of the product and services. But of course, we realize that there is a long list of the issue as well. One being that, for example, here demonstrating that now we have a lower capacity to perform risk diversification internationally. Another very important drawback is that because we rely upon international markets so intensively, whenever there's a big problem outside of the United States, there will be a spillover effect onto our economy, very much like the current pandemic. The current pandemic is one of the symptoms of over globalization, such that we could not deal with those very strategically important issues entirely by ourselves. So we started to think about that the pros and the cons of globalization, and so in the next 5, 10, or 20 years, probably that we will need to think it through that to what extent that globalization would be able to add value to our society, and to what extent that globalization might impose risk to our economy and to our welfare. So we will need to make a smarter trade-off toward globalization. Next slide. And this slide shows that the optimal international portfolio, if not the data from 1980 to 2012, is a good sample of what might happen in the future. And this, along the x-axis, is the standard deviation of the portfolio. Along the y-axis, we have the return of the portfolio. Of course, we want the standard deviation as small as possible. So along the x-axis, we prefer the thing to the left, and return, we like that to be as high as possible. So along the y-axis, our preference will be more toward the upper portion of this particular chart. And to the left or right, so our preference direction is kind of northwestern kind of direction. We hope that we'll be able to push toward that direction, okay? And we have that particular curve, and you might learn that in your Bsad 180, we call that efficient frontier. And then we have a risk-free rate that on the y-axis, and then give us a straight line of the capital market line. And we use this kind of standard Markowitz portfolio technique to derive an optimal portfolio. Let's take a look what this optimal portfolio would look like if the data from 1980 to 2012 is a good sample of the return population. And next slide. Okay. And here, if we only invest in the United States, that would be for the column of the domestic portfolio. And the next big set of column, that will be the optimal international portfolio. That would mean that if we allow ourselves to invest, not just in the United States, but also invest in other national market, and what might happen? And for United States, for investors living in the United States, we will need to read the bottom row. And as you can see that for American investor who only invest in the United States, the mean return is 0.65%, that will be per month. And the standard deviation would be 4.59% per month. So the Sharpe ratio, SHP, is 0.137. If American investor willing to perform international risk diversification by holding a well-diversified international portfolio, the mean return, that would be the second big set of column there. The mean return per month would be 0.75%, which is higher than the previous return of 0.65% by 0.1% if someone would not want to invest internationally. And at the same time, the standard deviation for this optimal portfolio would be 4.86% per month. So what happened to the Sharpe ratio? The Sharpe ratio now is 0.151, which is higher than the Sharpe ratio of 0.137 without international diversification. So the improvement of Sharpe ratio is still indicating that for American investor, there is some to be gained by doing international investing. And so we have a little bit improvement from 0.137 to 0.151. There's a little bit improvement, but that improvement is not like a, like a shockingly great amount of improvement. In contrast, for those investors living in a relatively small nation or a region where the investment opportunity set is relatively small, then their benefit of having that ability to diversify internationally, that benefit, that improvement is much more substantial. For example, let's take a look at the region of Hong Kong. And Hong Kong, that would be the fifth column, fifth row. Without investing outside of Hong Kong, for a typical Hong Kongese investor, the mean return is 0.78. Standard deviation 8.71. So the Sharpe ratio for Hong Kong only investment is 0.087. If Hong Kongese investor would be able to invest internationally, what kind of mean return they would be able to obtain? That would improve to 0.85%. But more importantly is that the risk would be reduced substantially to only 4.81% per month. Okay, so the Sharpe ratio would be improved to 0.173. So let's compare the Sharpe ratio with or without international investing for Hong Kongese investor. We are talking about 0.087 versus 0.173. So that is almost 100% improvement in Sharpe ratio. So for those investors living in a relatively small nation or relatively small region where their own domestic investment opportunities tend to be relatively limited, then there could be potentially great amount of benefit for investing internationally. On the other hand, for investors who live in the United States, because we already have plenty of investment opportunity, so yes, international investing still have benefit for our investor, but the benefit is much, much smaller. And that's what this set of numbers provide to us. Next slide. So during this time period, if we use this period sample, then what would be that optimal portfolio look like? And that is highlighted in the yellow column. And here, the investor ought to put 47.72% of his or her capital in the United States. Okay. And ought to invest 24.31% of his or her money in Sweden, and the remaining 27.97% ought to invest in Switzerland. Okay, so by splitting the money in this particular fashion among these three regions, that lead to the optimal portfolio. Okay, so next slide. Now we wanted to talk about the decomposition of the realized dollar return for U.S. investor investing in a foreign market. For example, I'm an American investor. If I want to invest in a British stock and list in London, then the return, RIS, that would be the return of that British investment I measure in US dollar, that would be the RI US dollar sign, would equal to the compounding effect of the two return. That's the reason why equal to 1 plus RI times 1 plus EI, and then we minus 1. The minus 1 is the subtract, deducting the principal. Principal being 100%. So we have the 1 plus return of the first asset time 1 plus return of the second asset, compounding return plus principal minus principal, then we have the compounding return. So that's a typical compounding return equation. And RI is the local currency return of that investment. Okay, so here we're talking about the return of my British investment measured in British pound. Okay, and then the EI is being the return that I earn by holding British pound instead of US dollar. So it is the rate of return on the exchange rate. So here we can see that the return one will be able to earn on a British investment is basically the sum, some sort of sum or aggregation of the return measured in British pound and also the return that I earn on holding on to British pound instead of US dollar. So this would be the two things. So we do the further expansion of that computation. So 1 plus RI times 1 plus EI. After the expanding, we have 1 plus RI plus EI plus RI times EI. And then after taking away that 1, so we only have those 3 terms left. on the right hand side of the equation. So here RI US dollar equal to RI plus EI plus RI times EI. We have this particular expansion. Okay, next slide. Given this expansion, okay, let's take a look at the numerical example. Suppose that I just saw a share in a British firm, and the return measure in British pound is 15%. So let's assume that I invest 100. I initially invest 100 British pound, buying some share, and after I sold those shares, okay, and the sales proceed was 115 British pound. So I bought at 100 British pound, I sold at 115 British pound. So what would be my rate of return measured in British pound? 15%. That is what 15% is about. That's what we refer to local return. Return measured in local currency. And during this holding period, let's assume that the British pound depreciate 5%. So holding on to British pound instead of US dollar, I lost 5%. Then what would be the rate of return measured in US dollar? Okay, and it would turn out to be 9.25%. So I would be able to only earn 9.25% for my US dollar. Okay, and that computation is 1 plus 15% times 1 minus 5%. So it turned out to be 0.925. Okay, in other words, I have to think of this way. I earn about 15% in local currency, but currency itself take away about 5%. So I only left about somewhere close to 10%. It's not entirely 10% because of compounding effect. To be exact, it should be 9.25%. So from economic tuition perspective, that's why the return measure in our home currency, US dollar, is 9.25%. And the expansion of that equation in the previous slide is copy and paste onto the next slide. Now I'm on slide number 14. So recall that RI US dollar equal to RI plus EI plus RI times EI. Now I'm interested about looking to the risk of my investment. Okay, so I want to know about the investment risk for my US dollar. Then that would be the variance RIS. Okay, that would be the second equation on this slide, and will equal to the variance according to the three term on the far right of the previous equation. Will be equal to variance of RI, that will be our first term. The variance of EI, that's the variance of the second term. In the first term and the second term, there is a covariance term. That will be two covariance RI, EI. And then there are other kind of terms for the third term, the relation between the third term and the first term, third term and the second term. We all lump those kind of remaining variance into the delta VAI. Okay. VAR, the delta VAR. So here we'll be able to, based on our return equation, to do a return decomposition into 4 different components. The first component is VAR RI, second one is the VAR EI, and then the two covariance RI EI, and then the delta VAR. Okay, so let's take a look at the next slide. So here, basically, this equation say that the exchange rate fluctuation, that will be anything relating to EI. So we want to know about how the exchange rate would have impact onto the variance of RI US dollar, because we care about our return measure in US dollar. But if we want to know that to what extent the return in US dollar is affected by the change in exchange rate, then we look into the right hand side equation that is relating to EI. The first term VAR RI, it does not have EI, so that term has no relationship, has no impact on the US dollar relating to the change in exchange rate. But the second term does have one. That would be the currency's own volatility. That would be the VAR, EI. And also there is it has the impact through a different channel. That would be through the covariance, the relationship between RI and the EI. How these two things co-move together also have impact onto the volatility of a return measure in US dollar. And the third source of the impact would be go through the delta VAR. That is a relatively complex kind of the term. Let's take a look at the next slide. And this next slide is something that very important to international portfolio manager. And in this variance decomposition chart, in this table, and the upper portion of the bond portfolio, the bottom portion of the stock portfolio. And there are fund manager out there that invest in stock. There are fund manager out there investing in bonds. So here we're talking about that for those investors who invested in international bond. Let's take a look. That's focusing on the third column. That would be the VAR, EI. Okay. And for Australian, that's 11.59. That accounts for 81.73%. For Canada, okay, that is 4.85, and that play a very as well a very important role, 60.90%. So this means that 60.9% of the return variability in US dollar is driven by the volatility in the exchange rate change. So exchange rate change has 60% of the impact onto the return measure in home currency. So that's very important source of the uncertainty. Similarly, for Germany stock, for Germany bond, we have talking about 82.65%. For Japan bond portfolio, 78.55%. Switzerland, 87.89%. As you can see, that all of those numbers are far greater than 50%. And on the other hand, the return of those bonds measured in those local currency, that would be the second column, VAR, RI. And they are play a secondary role, and they are like 33%, 44%, 25%, 16%, 16%, 40%, etc. for bond portfolio. In other words, that if you are international bond investor, you will pay whole lot of attention to how the exchange rate will evolve down the road, because the change in the exchange rate is going to have big impact on your performance of your bond portfolio measured in US dollar. Okay, so you will need to pay attention to the exchange rate. Therefore, you may want to do the hedging for foreign exchange rate risk. In contrast, for stock portfolio, that would be the lower half of this particular table. Let's look at those numbers underneath the VAR, EI. So here we want to know that to what extent a change in exchange rate is going to have impact on the stock return measured in US dollar for our investment. And let's look at those percentage. 28.94% for Australia, 13.44% for Canada, 20.63% for Germany, 24.26% for Japan, etc. You will notice that those numbers are relatively small. They are far less than 50%. On the other hand, the second column underneath of the VAR, RI, let's look at those VAR, RI. 43%, 61%, 83%, 82%, 86%, etc. And you will notice that the return measured in US dollar for stock investing and are largely driven by the return measured in local currency. That would be the VAR, RI. and it's not really being impacted that much by the change in exchange rate. That would be the VAR EI. Those VAR EI number, they are like 20%, 30%. They are secondary. So in other words, if in the future you manage an international stock portfolio, you have the luxury not to pay too much attention to the change in exchange rate, because those exchange rate change would have relatively small impact on your stock portfolio performance. Your stock portfolio performance will be largely determined by the return of your international stock measured in those national currency. So as long as you have a stock that goes up for example, in Tokyo Stock Exchange, measured in Japanese yen, then largely that you are going to have good performance in terms of US dollar. Okay, so you don't really need to worry that much about the change, the shock, the difference of the exchange rate associated with Japanese yen when you convert your Japanese investment back to US dollar investment. So this table is very important. It has tremendous practical implication for practitioner. Okay, it depends on whether you are international bond manager or whether you are international stock investor. You pay different level of the attention to the exchange rate market involvement. Okay, and the thing that I just told you have been summarized on slide number 17 and also on slide number 18, that you can read these two slides and the material in these two slides have been discussed earlier. Okay, so let's stop it here today. Next time when we come back, let's continue this topic.